Hello everyone! In this video, we're going to map out how to correctly utilize trend lines and explore advanced methodologies that will significantly improve your market execution. We are back with full momentum and a packed schedule of upcoming content, so make sure to subscribe and enable notifications so you never miss an update. The most frequent inquiry we receive is how to accurately draw and trade trend lines. Before we begin, feel free to comment below on what trading topics you want us to dissect next, and we'll do our best to create those videos for you. 1. What is a trend line? Let's start with the core concept. What exactly is a trend line? A trend line serves as a diagonal boundary of support or resistance, established by linking a sequence of swing highs or swing lows during an active market trend. Trend line, a straight line drawn on a chart to connect important highs or lows, helping traders identify the direction of the market trend. As you know, markets progress in the direction of the dominant trend, followed by temporary pullbacks. As this price action develops across your chart, it creates distinct swing points that can be connected to construct these diagonal lines. A trend line anchored to a series of higher lows functions as your support structure. However, remember never to execute a trade solely based on a single line. Always hunt for supplementary confluence, such as major horizontal support zones or Fibonacci retracement levels, aligning perfectly with your trend line. 2. How to draw trend lines correctly. Unfortunately, a large percentage of market participants plot trend lines incorrectly, so let's look at the proper method. To validate a trend line, you require a minimum of 2 prominent anchor points that align seamlessly. Ensure you select highly visible structural peaks and troughs. These must be clear swing highs or lows accompanied by a sharp, decisive move in the opposite direction. Typically, anchoring the line to the candle wicks yields the most accurate results. While using the candle bodies can be effective in specific market conditions, the key is consistency. Choose one technique and stick to it, rather than changing your approach to satisfy a personal bias. Many traders constantly change their methods simply because they see a particular example that works better on the chart. Today, they use candlestick bodies to identify market structure. Tomorrow, they switch to using candlestick shadows. And then they change again to another method. This inconsistency prevents them from accurately assessing the true effectiveness of their trading system. Why use trend lines? As previously highlighted, trend lines provide secondary layers of support or resistance. They bring visibility to critical price zones and unlock trade setups that you might otherwise overlook. Think of a trend line as a location where you should pay closer attention to market behavior. When price reaches a trend line, the next step is to look for additional confirmation before making any trading decision. This confirmation can come from 1. Price action patterns. 2. Support and resistance zones. 3. Market structure shifts. 4. Liquidity sweeps. 5. Technical indicators. The second major benefit of incorporating trend lines is that they provide early warnings of potential trend exhaustion and reversals. Think about it for a moment. A trend can continue for days, weeks, or even months, but no trend lasts forever. The challenge for traders is recognizing when momentum is beginning to fade before a major reversal actually occurs. This is where trend lines become extremely valuable. Fake breakouts versus true breakouts. Whenever price breaches a trend line, it typically signals one of 2 market behaviors. The fakeout. Price temporarily deviates past the trend line, leading breakout traders to believe a structural shift is occurring, only to rapidly reverse and trap those premature positions. When a fakeout takes place, you will notice that the candles at the breach point remain relatively small, indicating a lack of institutional intent. The optimal approach here is to anticipate the trap and look for an entry once the reversal is confirmed. The true breakout. The definitive differentiator between a fakeout and a genuine breakout is candle expansion. If you observe large, high-energy candles slicing through the trend line, followed by subsequent candles sustaining that momentum, it is highly likely a valid breakout. For maximum confirmation, wait for a secondary break of structure. Allow the market to clear its initial swing high to paint a new higher high, and then wait for that level to be breached once more. However, a single break is often not enough. Smart money frequently pushes price above a key level to attract breakout traders before pulling the market back. Key mind. This establishes a clear sequence of higher highs and higher lows. You can then look for an entry on the retest of that newly formed structural level, such as an old resistance turning into support to ride the new trend and maximize your gains. Chart examples. Example 1. The breakout trade. Let's analyze a few practical scenarios to solidify these concepts. In our first example, we'll look at a trendline breakout setup. The market displays a clear uptrend characterized by a series of higher highs and higher lows. Eventually, price stalls and begins compressing sideways, carving out a series of lower highs. We can connect these descending peaks to form our descending trend line. Given that the underlying macro trend is bullish and price has consolidated for an extended duration, we can anticipate a powerful impulse move matching the original direction. Wait patiently for an energetic candle to break above the trend line, followed by a subsequent breach past the previous local high to secure a new higher high. This sequence validates the return of bullish momentum, allowing you to enter long at the newly formed fair value gap or the retest of that broken high. These are typically areas where liquidity is rebalanced and large institutions can step in to add to their long positions. If buyers truly take control of the market, these areas will act as support and push prices even higher. The most important thing to remember is that we're not trying to enter trades as early as possible. Example 2. Fake out. But how do we handle deceptive breakouts? Here, we identify two obvious swing highs that can be linked together. As the price action unfolds, the market approaches this trend line for a third test. At this juncture, it appears as though a breakout is occurring, with two consecutive bullish candles closing above the line. While many retail traders would view this as a valid entry signal, you must always evaluate what is happening on the opposite side of the order book. If you look closely, this upward expansion lacks explosive energy. Looking to the left, the previous downward expansion featured candles twice the size of these current bullish ones. Additionally, we spot equal highs sitting right at this level, representing a significant pool of buy-side liquidity. With this data in mind, you must remain disciplined, demand more information, and wait for the market to reveal its true intent. Shortly after, a bearish engulfing candlestick forms, sending price sharply lower and breaching the previous swing low. This asset behavior confirms a bearish structural shift. You can now safely enter short upon a retracement into a newly engineered level, such as a fair value gap, placing your protective stop above the swing high and targeting lower liquidity pools. From here, the most logical target would be the lower liquidity zones. Look for previous lows, equal lows, or areas where many traders place their stop-loss orders. These are often the next magnets for price in a bearish environment. Example 3. Trend continuation. Next, let's examine a trend continuation setup using trend lines. Here, price is transitioning out of a clear downtrend, shifting its trajectory upward. It then pulls back to fill an internal market inefficiency before continuing its ascent. This gives us two reliable anchor points to construct our ascending trend line. Now, our strategy is simply to wait for the market to retrace back into this diagonal support zone. As price revisits the trend line, it dips slightly beneath it. However, the move completely lacks downward momentum and energy, the exact opposite of what we look for in a true breakout. As we monitor the price action for a rejection signal, a powerful bullish engulfing candle prints. You can scale into a long position here or wait for further validation. As the market accelerates upward, it prints a fresh higher high, providing ironclad confirmation of the bullish trend. This allows you to execute an entry on the retest of this old resistance area, which has now transitioned into a new support level. When old resistance zones are retested and transformed into new support, the market is showing us a core principle of trend-following trading. Areas that once prevented price increases are now supporting continued upward momentum. Your protective stop is placed below the low, with profit targets set at the structural levels above. Example 4. Trendline liquidity. Our final example is critical because trend lines frequently act as massive areas of liquidity. In this scenario, the market is locked in an established uptrend, printing consistent higher highs and higher lows. Knowing that the dominant momentum is bullish, your objective is to wait for price to test a key support zone before hunting for a long position. On this chart, we isolate a fair value gap resting just beneath the recent structural lows. We want to wait for the market to sweep down to capture liquidity before targeting the higher levels. Retail trendline traders will be utilizing this diagonal line as a major resistance zone, meaning a massive cluster of buy-stop liquidity is resting just above it from traders holding short positions. Because we understand that the macro trend is heavily bullish, the probability of a trend continuation is significantly higher. Therefore, we wait for the market to complete its retracement into the fair value gap below, enter our long position, place our stop loss beneath the gap, and target the high probability liquidity pools above. Large market participants understand where liquidity exists. Instead of fighting the trend, they often target these liquidity pools to fuel the next expansion move. Once enough buy-side liquidity has accumulated above the trend line, the market may aggressively push higher, triggering those stop losses and creating additional buying pressure. This is exactly why our target is not chosen randomly. We are targeting the most obvious liquidity pools above current price, where trapped sellers are likely to exit their positions and breakout traders may enter new long positions. Both groups contribute liquidity that can drive the market further upward. Now that you have successfully integrated trendline mechanics into your trading arsenal, go ahead and apply these rules to your own charts. Share this video with a fellow trader who is still struggling to identify high probability setups. And if you'd like to continue learning with our community, join us for our analysis sessions where we break down price action, market structure, liquidity, and key trading concepts in real time. Leave a comment below and let us know which trading topic you'd like us to cover next. We read every comment and many of our future videos are inspired by your suggestions. Thank you for watching. Keep learning, stay disciplined, and we'll see you in the next lesson.